Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin, but within the context of net liquidity. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Link is in the description below. Let's go ahead and jump in. So, net liquidity is this idea that we've discussed before, not only within the context of Bitcoin, but also within the context of the stock market. And really, I think that while it can be useful for looking at USD evaluations of risk assets, I think net liquidity is more interesting when you look at relative valuations of certain risk assets against other risk assets. And I'll try to explain what I mean. But the first thing I want to do is we're just going to pull up the indicator. Okay, so we have net liquidity right here. And if you're not familiar with what this is, I'm essentially adding up the balance sheet of several different central banks, including not only the Fed, for, the United States, but also Canada, New Zealand, Japan, China, the UK, the ECB, Australia. So those are the ones that we have included. And I'm also subtracting out the reverse repo and the TGA from the United States. So by doing all that, we get a metric that looks like this. Okay. Now, to show you a specific balance sheet, if you were to go look at, say, the Fed, right? If you were to go look at this one, you can see pretty clearly that the Fed has been reducing the size of their balance sheet really ever since 2022. There was this pop up here in March of 2023. I'm sure you guys remember that, but it's mostly been moving down. So why then has net liquidity not been moving down in the same manner, right? You can see that net liquidity, while it has moved down, it hasn't really moved down as quickly as the balance sheet from the Federal Reserve. One of the reasons is because when you look at net liquidity, at least in the United States, you also have to consider the reverse repo facility and the Treasury General account, the TGA. And if you do that, if you look at, say, the reverse repo, what you'll notice is that it has been aggressively coming down. But with reverse repo, you almost have to think about it in reverse. If this is going down, then liquidity is being put back into the market. So for that reason, you're subtracting. You take total assets from the Fed and you subtract out the reverse repo. So as long as this keeps moving down, liquidity is being continuously pumped in. Now, you might have seen a lot of people are talking about, well, when is this going to run out? People are speculating all sorts of times. They used to say it was going to run out in January. Obviously, we're past that, and it's still at $500 billion. So I don't know. I don't know exactly what the path for it is, but you can see this is one of the reasons that the net liquidity hasn't gone much further down. Another reason is, of course, the Treasury General account, and I'll go ahead and paste that in here as well. And that looks like this, right? It's actually gone up recently. So the point is, if you take the balance sheet of the Fed, and from here we subtract out the reverse repo. So let me pull this up. That one. And then we subtract out the TGA. You get something that looks like this, right? Now, when you look at this, you can see that that actually looks a lot similar to this than if you only include the balance sheet of the Fed. But there are still some differences. For instance, this was a lower low compared to this, which was a higher low. So why is that? Well, remember, we're also looking at the balance sheet of a lot of central banks, not just the Federal Reserve. We also have Canada. So if I pull up that one, you can see what it looks like. Sorry, that's the wrong one. Here's Canada's the balance sheet there. You can see that it's been going down pretty steadily. And we also have many, many others. One of the ones that's actually been going up, though, is China. Go look at the balance sheet of in China. You can see this has actually been going up quite aggressively. But one issue is that this is denominated in local currencies, right? So if you're going to add up the balance sheets of various central banks, then you have to convert it back to US dollars. And that's where the dollar comes into play, right? Like, that's where the dollar, we have to understand that, what is the dollar doing? And since the dollar has it initially came down quite a lot, but in recent weeks it's starting to go back up. Now, if it goes up, that sucks liquidity out. Okay, if you think about if a central bank has favorable conversion to US dollars, then that means there's more purchasing power. Okay? But if the dollar has gained strength against those local currencies, then that means there's less purchasing power from those, so from those balance sheets of the other central banks. So the dollar also plays a role. But at the end of the day, you get a chart that looks like this, right? You get a chart that looks like this. And for a long time during a business cycle, especially when the drop begins as net liquidity goes down, for a while, risk assets will track net liquidity, right? We can overlay this and see it pretty clearly, right? For a while, risk assets like Bitcoin, like the S&P, will track net liquidity. But every single cycle, eventually, what we've seen is there becomes a divergence between them, right? Where one will, the risk asset will diverge from net liquidity. And this is a reason why there's a lot of people that really dismiss the idea of net liquidity because of this divergence. I mean, of course, you could look at prior cycles and say, yeah, well, it does diverge at some point, but given enough time, the asset will tend to go back to that level. The problem is that can take years, right? And if you're counting on that as your investment thesis and that alone, then you could be, just simply waiting around for years, waiting to see if something actually plays out or not. It could be better visualized with, say, like the S&P 500 last cycle, right? I mean, if you look at what the S&P, let me switch this over to not a monthly time frame. So there's a little bit more resolution in it. I mean, like last cycle, you can see that at some point the jaws of liquidity opened, and eventually they snapped shut. Right? Again, the jaws of liquidity opened here, and then eventually they snap shut. So you might look at this and say, well, what use is it? Right? What use is it if the risk asset in question can diverge from net liquidity? And I think there's actually a great answer to that question, and it all goes back to what happens in late business cycle types of environment. And what happens is higher risk assets bleed to lower risk assets, right? We've seen that. Not only have we seen it with like altcoins bleeding back to Bitcoin, right? If you look at total 3 divided by Bitcoin, not only do you see total 3 continues to bleed back to Bitcoin, but also things like the Russell are bleeding back to the NASDAQ, right? You can see this is the Russell going back down, bleeding against the NASDAQ. And so there's this idea that, rather than use net liquidity to understand risk asset valuations on their USD pairs, you can use net liquidity to understand likely outcomes of higher risk assets to lower risk assets. For instance, taking a look at the Ether Bitcoin pair, right? The ETH Bitcoin pair. Now, I do consider Bitcoin to be a safer investment than Ethereum. That doesn't mean that I'm not long-term optimistic about Ethereum's chances, but what I do mean is that the Ethereum valuation has been, and we've talked about it for years, and will likely continue to bleed back to Bitcoin until we go back to looser monetary policy. And when you look at the chart in this manner, it actually seems to line up a bit more closely, right? And maybe switch over the ETH chart to a line scale. And let me actually move this back so we can actually see, really what's going on here. What you'll notice, you see here how ETH Bitcoin kind of put in a slightly lower low. Same idea with net liquidity. Now remember, net liquidity has nothing to do with the ETH valuation, right? It's concerned about the balance sheet of the central bank's balance sheet. And also it does take into account the dollar. But you can see pretty clearly in a chart like this where net liquidity can be actually useful, because it shows you that a higher risk asset in the crypto space, Ethereum, has been bleeding to a lower risk asset, Bitcoin, right? And it's basically mimicking the net liquidity model, where you can see that as net liquidity goes down, so too does the ETH Bitcoin valuation. But Ethereum is by a long shot, not the riskiest asset in crypto. In fact, after Bitcoin, it's probably the safest one after Bitcoin, Bitcoin being the safest. Then Ethereum, then there's the altcoin market. Now, if you were to look at it through the lens of the altcoin market, let me pull it up over here. And again, if you look at total 3, just the USD valuation, it tends to line up better with net liquidity, but it's still not a perfect match. But what I would say is go look at total 3 minus the stable, minus USDT, and then divide that by Bitcoin. And when you do something like that, you get a chart that looks like this. And here you can see how it lines up a lot more closely. I mean, it's not perfect. I'm not trying to imply that it is, but here you can really see how altcoins are bleeding back to Bitcoin, right? This white line shows relative alt Bitcoin valuations. And you can see clearly how alt Bitcoin valuations are bleeding. And you can also see how net liquidity continues to go down. Now, all of this is important as an investor because if you are an investor and you like taking on risk, you always want to know where should you put your money to maximize your risk-adjusted returns. If you think about what's happened over the last couple of years, the Magnificent Seven in the S&P 500 is essentially the only reason why the S&P is even at new all-time highs, is because of these few stocks that have outperformed most of the rest of the market. However, there are many times in history where this is exactly the case, where higher risk assets, where only a few stocks in the S&P 500 outperform, and those are the ones that are responsible for taking the S&P higher. A lot of people might point to this to say, well, this is the only reason, but that's how it often happens. And that's one of the reasons why outperforming the S&P 500 is incredibly difficult, because unless you can pick the exact stocks that are going to give all the gains, there's a good chance that you end up picking some stocks that just keep on going down. And that's why most hedge funds do not even keep pace with the S&P 500, is because they're not better stock pickers than just buying the index. I mean, and this is not my opinion. I mean, this has been proven time and time again. We've seen reports, at the end of fiscal years where it'll show you, how many hedge funds have actually outperformed the S&P that year, and it's always really few, right? And they have a lot of smart people at these hedge funds, and I'm sure trying to make all sorts of decisions. And there are some that do occasionally outperform, but even the ones that outperform for a while, they tend to not outperform for many, many years in a row. Again, every once in a while, you'll find one that does, but the problem is that most of them ultimately fail to even keep pace with the S&P 500. So my argument is that you can use this idea of net liquidity to better understand which types of assets are worth owning. For the last couple of years, I've reiterated many times that my crypto portfolio is basically just Bitcoin. And I have been very critical of alt Bitcoin pairs for a long time. I do want to remind people that there are always a few altcoins that outperform. And I congratulate anyone who's made a lot of money in the altcoin market, okay? A lot of altcoins have moved up off of their lows, and I'm not trying to diminish the risk that someone took on and then the reward that they received. I saw the exact same thing last cycle, and last cycle I was a lot heavier in the altcoin market than I am this cycle. Well, what happened last cycle is I just saw these altcoins bleed back to Bitcoin until the Fed started to cut rates. So you might wonder, well, when will altcoins finally stop this horrendous downtrend against Bitcoin, right? When will it end? And one way to view that is to simply look at interest rates, right? I mean, you could go look pretty clearly at interest rates and see right away that at least last cycle, if you look at last cycle and we pull up, say, total 3 divided by Bitcoin, the altcoin market against Bitcoin. Sorry, actually, let me pull it up. I'm going to pull it up the other way. I'm going to pull it up so that... So here we have the altcoin market, right, against Bitcoin. And what I want to do is I want to overlay interest rates onto this chart. So you can see pretty clearly here that once the Fed started to cut rates right here, altcoins were pretty close to bottoming out against Bitcoin. They still had a little bit to go. But what's more interesting is if you also overlay the balance sheet of the Federal Reserve, you can see that they started to increase the size of their balance sheet precisely at the time that alt Bitcoin pairs finally bottomed out, which again corresponds, if we pull up that indicator again, net liquidity indicator, right here, you can see that that loosely corresponds to near the lows in net liquidity. So when we think about net liquidity, are we using it to tell us USD valuations of risk assets? No. We've talked many times about this with net liquidity and how the jaws of liquidity will open at some point during the business cycle. So if you're only using liquidity to tell you where the market's going to go, you're probably going to be in for a bad time. But if you use net liquidity to give you an idea of where relative valuations of risk assets against other risk assets are going to go, I think that makes a lot more sense. And that way, if you're an investor, you can focus your money on the lower risk assets if you want some exposure to the upside, while also minimizing your downside risk, right? And so pretty clearly right here, this is where net liquidity bottomed in September of 2019, right? You can see that's where net liquidity bottomed last cycle. And that's precisely where alt Bitcoin pairs bottomed out themselves. Isn't that fascinating? And so when you look at a chart like this, it really does make a lot more sense. Here you can see how altcoins outperformed Bitcoin as net liquidity went through the roof. But then as net liquidity goes down, alt Bitcoin pairs go down. And a lot of people keep calling the top on Bitcoin dominance because of you know what they saw happen, or sort of they're thinking that altcoins will perform better this time. But my point is, last cycle I mean again, it's only one data point, but it's technically more than one data point if you think about it, because this same type of idea could be studied for various markets going back many centuries, right? The idea that in late business cycle environments, higher risk assets bleed to lower risk assets. And the reason for that is because the higher risk asset, we are pretty confident will survive whether it's a no landing, whether it's a soft landing, or whether it's a hard landing, right? Whatever type of landing it is, out of those three, you expect the lower risk asset to survive. But what you don't, right? You would expect Meta or Alphabet or Apple, or Microsoft, right? You would expect those to survive because they have a healthy balance sheet, so you're not really that concerned, okay? Now, could you say the same thing about a random company that only started up a couple years ago and has not had the time to build up a healthy balance sheet? Can you say the same thing about that company? And the problem is that we can't. But as investors that are seeking out risk, if you want to put your money somewhere, if you're seeking out yield, if you want to find a home for it, what a lot of people do is they go to the lower risk asset during quantitative tightening and during a late business cycle environment. Because two reasons. First of all, investors want to take risks, right? And they want to enjoy on the upside. Second of all, they want to minimize their downside risk if there is a hard landing, right? Because if there's a hard landing, everything gets rinsed, but at least the lower risk stuff won't get rinsed as bad, and it'll probably be pretty quick to recover. So that's where we are, right? We continue to be in that type of environment where it's late business cycle. And what I mean by late business cycle is I just mean that in terms of interest rates, right? Like this yellow line, in terms of interest rates, like mid 2019 was late business cycle because it was just before the Fed started to cut. So that's what I mean by late business cycle, is we're sort of coming up on rate cuts at some point this year. We don't know exactly when that's going to be, and good chance right now that it's not even going to be in March. So if it's not going to be in March, then perhaps the next best time is May. And that would imply that Bitcoin dominance could continue to go up for a while. And when it comes to Bitcoin, we know that what it really likes to do, is it likes to sort of break risk. It likes to break all Bitcoin pairs down during rallies, right? So if it goes up, I mean, I already drew it out here, right? But if it goes up, then it breaks all Bitcoin pairs down. Or if it goes down, then it breaks all Bitcoin pairs down. But for a long time, it has just simply gone up during this late business cycle environment. And a lot of these altcoins simply bleed back to Bitcoin. And my argument is that we will likely see that shift on the other side of monetary policy when we get back to looser rates or looser monetary policy, lower rates. That trend will likely shift. But until that time, I think the status quo will remain unchanged. And so net liquidity, I think, is a great indicator to understand the current market cycle. I think people may go astray when they use it to tell them where USD valuations are going to go, when in reality, it's a much better tool for better understanding where the relative valuations of higher risk assets are going to go compared to lower risk assets. And so that is what I want to talk about today with net liquidity. Hopefully you guys found that useful. Again, if you guys like the content, make sure you subscribe, give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.